Floating rate notes, FRNs, are bonds whose coupon payments adjust periodically according to a specified reference rate, such as a market reference rate, MRR. Because coupon payments reset with market interest rates, FRNs generally exhibit lower interest rate risk than fixed-rate bonds. However, some FRNs contain embedded options that alter their cash flow characteristics. Two common variations are capped floaters and floored floaters. A capped floater limits the maximum coupon rate that investors can receive, while a floored floater guarantees a minimum coupon rate. These embedded features affect valuation, risk exposure, and investor return expectations under changing interest rate environments. A capped floater includes an embedded interest rate cap that restricts the coupon rate from rising above a predetermined level. This feature benefits the issuer because it limits interest expense when market rates increase significantly. For investors, however, the cap reduces the potential benefits of rising interest rates. A capped floater can be viewed as a standard floating rate note combined with a short interest rate cap position held by the investor. As market rates approach or exceed the cap level, the bond begins to behave more like a fixed-rate security. Consequently, its sensitivity to further increases in interest rates becomes more pronounced. A floored floater contains an embedded interest rate floor that establishes a minimum coupon payment regardless of how low market reference rates decline. This feature benefits investors by protecting income during periods of falling interest rates. From a valuation perspective, a floored floater can be viewed as a standard floating rate note plus a long interest rate floor owned by the investor. When market rates fall below the floor level, coupon payments no longer decline, preserving the bond's cash flow stream. As a result, floored floaters are generally more valuable than otherwise identical standard floaters because they provide additional downside protection. Convertible bonds are hybrid securities that combine characteristics of both debt and equity. In addition to receiving coupon payments and principal repayment, bondholders possess the right to convert the bond into a predetermined number of shares of the issuing company's stock. This conversion feature gives investors the opportunity to participate in equity appreciation while retaining many of the protective features associated with fixed-income investments. Because of this valuable option, convertible bonds generally offer lower coupon rates and lower yields than comparable non-convertible bonds. Their value reflects both the bond component and the embedded equity conversion option. The valuation of convertible bonds depends on several key concepts, including straight value, conversion value, and market conversion price. Straight value refers to the value of the bond as if it were a traditional non-convertible bond. Conversion value represents the current value of the shares that would be received upon conversion. The market price of a convertible bond typically exceeds both values because investors are willing to pay for the flexibility provided by the conversion option. The difference between the bond's market price and its straight value is often referred to as the premium over straight value and reflects the embedded option's worth. Convertible bonds provide a unique risk-return profile that appeals to both issuers and investors. Investors benefit from downside protection through the bond's fixed income characteristics while retaining upside potential if the issuer's stock performs well. Issuers benefit by reducing borrowing costs because investors accept lower coupon rates in exchange for conversion rights. The value of convertible bonds is influenced by factors such as stock price movements, interest rates, credit quality, volatility, and time to maturity. Together, capped and floored floaters and convertible bonds illustrate how embedded options modify traditional bond structures, creating securities with distinctive valuation characteristics and risk exposures within fixed income markets.